Good morning, everyone. Welcome to Monday. Welcome to a new week. Welcome to Monday Minutes. Looking back to last week, the story in the market clearly on the corporate issuance side, a barrage of corporate issues. Expecting another full week this week, but certainly likely not to the extent that we saw last week. And when looking at it at this point in the year, looking at corporate issuance, looking at financial conditions, looking at negative real interest rates, credit spreads still extremely tight, rates still extremely low. You look at the US dollar, you look at equities, albeit coming off a little bit lately, still with very, very good returns year to date. Financial conditions are still very loose. Corporate balance sheets, very secure, a lot of cash. Some of this issuance opportunistic and otherwise retiring old debt and issuing new debt at extremely attractive levels. So short term makes sense. Looking ahead in the course of this year, the Fed in their blackout period this week. But looking ahead, we have a meeting next week, the Fed meeting. We don't expect any formal announcement for taper. Our timeline has been more in the November camp, with a taper likely beginning toward the end of this year, December, perhaps at the beginning of next year. But basically laying the groundwork now for what is to come later in the fourth quarter of this year, contingent mainly upon the employment side of the equation. Looking at the data this week, with that, we do get CPI print tomorrow. The Fed has basically finally thrown in the white flag with regard to the inflation dynamics right now, with regard to at least the taper and substantial progress. Powell himself admitting, Williams, that the Fed has made substantial progress on the inflation side. No real great surprise. It's really the employment side of the equation here that the Fed is looking at. From our perspective, the employment market is for all intents and purposes, is very, very tight. Over the weekend, the Wall Street Journal, the Great Resignation. You look at these dynamics in terms of job openings. We can look at unemployment, extended benefits. We can look at child care. We can look at the pandemic-related dynamics. We can look at mobility within the workforce. We know the quits numbers are quite high. People looking for new jobs. Those jobs need to be replaced. There is no one particular variable right now that explains the dynamics within this employment market as we emerge from the pandemic. But the bottom line here going forward, we have a tight labor market. The Fed needs to acknowledge that, I think, a little more substantively going forward. I do think we will hear from Powell next week saying how he thinks it's very likely that the Fed does meet that criteria for substantial on the employment side, albeit a little bit more slowly than we'd like as we head into the November meeting and the latter part of this year. On the ground this week, very light in terms of Treasury supply. Looking toward tomorrow, obviously CPI. Like we said, the Fed has thrown in the towel with regard to substantial progress and the taper with regard to inflation. Industrial production, capacity, utilization. We'll get another claims number. And then once again, with regard to the inflationary numbers, we saw a precipitous drop in Michigan last month. We will get those surveys again later in the week. I'm Greg Faranello, wishing everyone a great week ahead. I'm head of rates for AmeriVet Securities.